Welcome to Objective 2 in Unit 1 of Accounting 3310. We've already gone through the initial slides of this presentation. We've learned how to use debits and credits to describe a transaction in a clear and unambiguous way. And this portion of Objective 2 is going to apply that analysis now to actual transactions. So I'm going to step through each of the transactions on these last slides and discuss why we have the interpretation that we would have for each of these transactions. Our summary here is this, that for every transaction, at least two accounts change with every business event. For example, if you purchase a building for cash, there's an increase in the asset of building and a decrease in the asset of cash. You can't just record the increase in building because you haven't completely described the transaction. You also have less cash, and our fundamental accounting equation acquaints you of that point because you would have increased assets so that they no longer equal liabilities plus owner's equity. So recording the decrease in cash also brings you back into balance. In more complex transactions, it is certainly possible to have more than two accounts change, but what remains the same is that there will always be a balance in the equation. That balance can be identified by having equal debit and credit entries. Thus, identifying the changes as debits and credits allow a way of helping us to do the analysis and then checking the analysis when we're done. Let's start with purchasing a building with cash. Our fundamental accounting equation of assets equal liabilities plus owner's equity will stay in balance if we decrease cash and increase building. Let's say that we sell the building and receive cash. So if we sell it for exactly the value that it has on our books in this simplified case, we have kind of the opposite transaction. We're getting cash in that increases cash, but we no longer have the building. So again, we've got a balanced journal entry. Let's take a look at more transactions with assets. What if we buy a building, but instead of paying cash, have a mortgage on it? That will increase the building just the same as before, but now it increases liabilities of mortgage payable to that amount. So we've got an increase in a building and an increase in mortgage payable. The increase in the asset is the debit. The increase in the liability is the credit. Now, what if we have a combination, which is the most common case, where typically when buying a large asset, there's at least some amount of cash that has to be paid. So here, we both pay a down payment of cash and have a mortgage payable. Here, the decrease in cash fits the definition of a credit, decrease in an asset. The increase in building is the definition of a debit, increase in an asset, and the increase in the mortgage payable is the credit. So the two credits, decrease in cash, increase in mortgage payable, have to add up to the exact same amount as the increase in the building. I think that makes perfect sense to you. Let's think now about transactions with more liabilities. If we borrow money, then we have more cash because we've just obtained the cash from our lender, and we have an obligation to repay it. So borrowing increases assets and increases liabilities at the same time. Do you know which one's the debit and which is the credit? Increase in cash, increase in an asset is the debit, increase in a liability, that's the credit. They're equal to each other. When the debt is repaid, with some simplification here to ignore interest, we're going to pay off that note by paying cash. It uses up our cash and the obligation goes away. So when we pay off a liability, we have to remember to decrease that liability and take it off of our books. Here, decreasing cash is a credit. A credit's a decrease in an asset, increase in liability, increase in owner's equity. A liability is here a decrease. That's the definition of a debit. Increase in an asset, decrease in a liability, decrease in owner's equity. If we move on to typical owner's equity transactions, think about issuing shares of stock to investors who are going to become owners of our company. They pay the company cash. So remember, we're always recording this from the business's point of view. So the business now has more cash and has an increase in its capital or in its common stock account. When owners receive cash dividends paid by the business, they are going to receive cash from the business, so the business's cash goes down, and we have dividends declared. That's a decrease in owner's equity. Now let's think about company performance information. Revenues are in changes in owner's equity because of transactions with customers. Expenses are going to be decreases in owner's equity because of transactions with customers. So here, when we have a sale to a customer for cash, the company now has more cash and has an increase in revenue, which is part of the retained earnings account under owner's equity on the balance sheet. When we go to selling to a customer on account, that is, think about it as they're buying with credit. I don't want to use the word credit here because it has a different meaning, so I'm using the term on account. If we still have the increase in owner's equity because we've provided goods and services to customers, that increases the wealth of the company because we are charging the customer for providing those goods and services, and what we have is a promise from the customer to pay us. That's the accounts receivable. An increase in an asset here is a debit. An increase in owner's equity because of a sale to customer, that's the credit. Let's think about other forms of customer sales. We could have a business in which customers prepay. We talked about that back in Objective 1 when we discussed those kind of businesses that have customers prepay, like airlines. So we could have a customer who pays us before they receive their goods or services. That's an increase in the asset of cash because they have paid us. And it's an increase in a liability because we owe them future goods or services. The name of that liability is unearned revenue. Which one of those is the debit? The increase in cash. Increase in an asset, decrease in liability, decrease in owner's equity is the debit. When services are actually provided, we're not getting any additional cash from the customer. You don't pay all over again for your airline ticket when you're ready to step on the plane. So there's no assets involved at that point. It's totally a transaction from the point of view of the customer. They have now fulfilled the liability to the customer, so that liability goes away, it decreases, and they've provided the goods and services. That's the definition of revenue. We increase the wealth of the company by providing customers with goods and services. The decrease in unearned revenue is the debit. The increase in revenue is the credit. Let's think about the other side of providing goods and services to customers. When we use resources in providing goods and services to customers, that's the definition of an expense. So, one expense we might have is rent expense to pay for our premises. If we pay for our rent with cash, it's a decrease in cash and a decrease in owner's equity for rent expense. If we purchase inventory for cash, at first, that inventory is owned by the company before we give it to our customers. So it initially is an increase in inventory when we get those products in and a decrease in cash. That's a trade in assets in which the increase in asset is the debit, the decrease in asset is the credit. Only when we sell the inventory does an expense take place. That's when we have cost of merchandise sold or cost of goods sold and a decrease in owner's equity. When we use up resources in providing goods and services to customers, that's an expense that decreases owner's equity, and we have a decrease in the assets of inventory because we've handed the customer that product that they've bought from us. Decrease in an asset, decrease in owner's equity. We could also think about these series of expenses and how they interact with liabilities. If we purchase inventory on account instead of paying for it right away, then the increase of the asset in inventory is matched with an increase in accounts payable, that normal business liability where we didn't have to pay cash immediately. We're going to wait till we get the bill from our supplier and then pay the bill later on. When we pay for the inventory, they don't ship us more inventory. The transaction is totally one of our paying cash, and it eliminates the liability because we've now fulfilled it. Decrease in cash, decrease in accounts payable. Again, when we actually sell the inventory to a customer, then we'll have the decrease in the asset of inventory and the decrease in owner's equity that is called an expense of cost of goods sold. When we look at this, which is the debit and which is the credit? Well, we've got a decrease in the asset of inventory, that's a credit, and we've got a decrease in owner's equity, that's defined to be a debit. Let's think now about when we obtain goods and services ahead of time before we use them up. We talked about inventory before. What about a service like insurance? We don't actually get a product in our hands then, but it actually works the same way because prepaid insurance is just as much an asset as inventory is. We have claims to insurance coverage for a period. That's a right that we've purchased. So paying for insurance coverage ahead of time uses up our cash and gives us an asset called prepaid insurance. We have claims to insurance coverage. When we actually have the insurance coverage being used, that is, throughout the month, then we're going to show that we've used that resource of prepaid insurance and we have insurance expense from using up resources in our business. As the asset is used up, we have a decrease in the asset. So a decrease in prepaid insurance is the credit side, and insurance expense, decrease in owner's equity, as the resource is used up, that's going to be the debit side. Now, let's look at more expenses. What if we have something that's a resource that even though we use it, it's not completely gone? So when we use equipment in providing goods and services to customers, at the end of that we still have the equipment, but the more we use it, we have wear and tear, and that's called depreciation. Let's set up this. When we purchase equipment, that's just a trading of assets. So we have less cash, more equipment. We've recorded that sort of transaction already. Now when we use the equipment, we're going to be recognizing the portion of the equipment we've used up and decrease the value of the equipment on our books. So we decrease the asset of equipment and we decrease owner's equity as depreciation expense. It's the using up of the resource of equipment slowly over time, so that in each period in which we use the equipment, we'll be recording depreciation expense. If this equipment lasts for 5 years, we'll have depreciation expense recorded in each of those 5 years. This gives you an overview of the kind of transactions that you probably have already recorded when you were in a Principles of Financial Accounting class. If you've never recorded them using the debit and credit conventions, this series of transactions, I hope, will allow you to apply the debit and credit terminology to analyzing transactions. If you used debits and credits before in analyzing transactions, then this gives you kind of a leveling to remind you of the kind of transactions that you should already be familiar with through the beginning of this class. We're going to pick up from these kind of transactions and look deeper into all of the economic events involved in the operating cycle of a company. Thank you.